Thank you, Helen, and welcome to CP Australia's webinar on financial reporting updates, specifically the removal of special purpose financial reporting. That is the focus of today's webinar. My name is Ram Subramanian, and I'm the Senior Manager for Reporting and Audit Policy at CP Australia. We have people joining us from all over the country for today's webinar. I would like to take a moment to acknowledge the traditional owners from around Australia and pay my respects to elders past, present, and emerging. I extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. I would also like to acknowledge that today we are joined by the CP Australia Board Director, Louise Cox, FCPA, online. Thank you for joining us, Louise. Today we will be taking questions through our Q&A box. We will address the questions at the conclusion, and we will do our best with the time remaining to answer all questions. For any troubleshooting queries, please send a message to the host using the chat box. So let's kick off today's webinar. So during this time of the year, just before financial reporting season kicks off, we normally do a financial reporting update on latest developments for the upcoming financial reporting season. This year, we've decided to focus on the biggest change for 30th of June 2022, and that's the removal of special purpose financial reporting, which will affect financial reports for this year end coming. This was and is a major project being undertaken by the Australian Accounting Standards Board in 3 phases. The first phase, which was concluded about 2 years back, addressed the removal of special purpose financial reporting for for-profit entities, and that will be the focus of this webinar. So we've allocated 1.5 hours for this session. I'll present for roughly the first hour or so, which should leave us around 20 to 30 minutes to address questions. And like I said before, please continue to post your questions throughout the presentation using the Q&A function. My colleague Nadi is also present at this webinar. She will also answer some questions as we go along, and we'll also deal with others once my presentation is completed in the last half hour or so. Right, so here's an agenda of what we're going to focus on in terms of the topic, which is the removal of special purpose financial reporting. We'll be looking at how the changes have been implemented by the AASB, the Australian Accounting Standards Board. I'll refer to that body as the AASB from here on. And also what you will need to consider in implementing the changes yourself. So we're looking at it from a practical perspective, but we'll also cover some of the technical aspects. Then we'll look at who is affected in general when looking at the scope of the reforms, and also look at the impact on specific types of for-profit entities. Following that, we'll look at the changes to the content of financial statements for those entities that are affected, and also what entities that are not affected should be considered, as some entities that can continue to prepare special purpose financial statements will have to make some additional disclosures going forward. So the focus of this session is on special purpose financial reporting, as I said, and we've actually just yesterday released a brand new guide on the removal of special purpose financial statements topic, which was uploaded just yesterday. The link to the guide, the link to the page where the guide is available is provided on this slide. We will be making the slides available, so feel free to navigate to the guide and have a read. We've developed the guide in partnership with CINZ and HLB Manjad, and thank you to my colleagues in those organizations who helped develop this guide. Now, the guide sets out in detail many of the practical impacts arising from this big change, as I said earlier. So please do visit the link provided here and use this as a resource as you get involved in preparing financial statements for 30th of June 2022 year end. And of course, if you're an auditor or an advisor, you may want to share this resource with your clients who are potentially impacted by the change. So, how has the AASB gone about making the changes and removing the ability of some for-profit entities to prepare special purpose financial statements? Now, the important thing to note is that these changes impact the preparation of financial statements, and I'm very specific on that term, and we've highlighted that in red for you. Financial statements that state compliance with Australian accounting standards. So those two terms are quite important, and I'll talk to that a little bit more in detail as we progress through the presentation. The other thing, of course, as I said earlier, is that this impacts financial reports prepared for years ending 30th of June 2022 and beyond. Now, there are two main standards that were developed by the AASB to implement these changes. So the first one is AASB 2020-2, amendments to Australian accounting standards, which I'll talk to in a bit. And the second one is AASB 1060, general purpose financial statements, which focuses on simplified disclosures for Tier 2 preparers of general purpose financial statements, and I'll talk to that in a bit as well. So both these standards are mandatory for financial years beginning on or after 1st of July 2021, which would of course mean if you're a full year, looking at a full year, 30th of June 2022 and beyond. Now, early adoption was permitted, but that's no longer, that's a moot point now, because 30th of June 2021, you could have prepared general purpose financial statements under these new changes, and you had an advantage in doing that, in that you wouldn't have had to restate your comparatives. But then that was 1 year ago, so let's not focus on that. Let's just look at 30th of June 2022 and what this means for this particular year end coming. So what are the changes? Implementing the changes will require a very careful analysis of what your existing financial reporting requirements are. And the entities will then have to determine whether they are within the scope of these changes or not. And then you'll have to determine the extent of the impact. Now, the reason I say this is because there's a couple of things to keep in mind here. One is the change made by the AASB, which I'll talk to in a minute. And the other is any requirements that apply to you as a result of the change. So what are the requirements that apply to you in terms of statutory, legislative requirements, or other requirements which may be relevant to you as a result of the change? So those are the issues that you need to consider when you're looking at the scope and extent of the impact. So as I said earlier, the changes come through two amending standards, AASB 2020-2 and of course AASB 1060, which is not an amending standard, it's the main standard that deals with simplified disclosures. The entities that are within the scope of the changes are those that are highlighted here. And that's a change made to Statement of Accounting Concept 1, which is the reporting entity concept, which no longer applies to for-profit private sector entities that are required by legislation to prepare financial statements that comply with either Australian accounting standards or accounting standards, and other for-profit private sector entities that are required only by the constituting document or another document to prepare financial statements that comply with Australian accounting standards, and then others that choose to do so for various reasons. Now, as I said before, it only affects for-profit entities at this stage. That's phase 1 of the AASB project. There are changes being made currently or being developed currently by the AASB, which will remove special purpose financial reporting for not-for-profits at a future date. And similarly, there is a project separately being considered for reporting by public sector entities as well, which will come into play at a later date. I'll talk a little bit about that later on as well. So, identifying the scope of the reforms. So, as I said earlier, the key words that you need to look out for, one of the first key words that you need to look out for is the term financial statements. Whatever you are basing your requirements on, so what drives you to prepare financial statements, does that include the term financial statements? That's the first thing you need to look out for. And it's also important that not all requirements that include the word financial statements are captured. It needs to be combined with the words Australian accounting standards or accounting standards, which I mentioned in my previous slide. It can also be that in some instances, like as in the Corporations Act, you can have a term financial report mentioned, and that will include the term financial statements. So you will prepare financial reports which include financial statements, and those financial statements will have to comply with accounting standards. Now, there are some types of financial information that is prepared that is out of scope, and I've given you some examples there. That will include the preparation of financial information. So not reference to financial statements, but to financial information, that's out of scope. If there's a requirement to keep accounting records, that's also out of scope. If you are required to prepare a single financial statement, so for example, you may be asked just to prepare an income statement or a revenue statement or a turnover statement or just a cash flow statement, that's not in itself a set of financial statements. So that's outside the scope of these changes. Also, if you've got a requirement to prepare financial statements that give a true and fair view, that would also be outside the scope of these changes. So we're not looking at preparing financial statements in accordance with accounting standards or Australian accounting standards. We are only required to prepare financial statements that give a true and fair view. That would not be captured. And then financial report, if not defined. Now, the Corporations Act does define financial report, which must include financial statements that comply with accounting standards. So that would be captured. But if there is a reference to a financial report in somewhere else in another legislation, which doesn't specifically make use those specific words, then they are outside the scope of these changes. So we've actually, as part of the guide that I mentioned, we've developed a flow chart to try and work out a decision tree of how you might be affected by these changes. So as you can see from the flow chart that's just sort of shown on this page, it can be a somewhat involved scenario that you're looking at. But you can work your way through it. So all you need to do is firstly identify what your reporting requirements are, and then overlay on top of that the AASB's changes. And with the assistance of things like the guide and other resources, which I'll mention to you later, you should be able to work your way through and find a suitable answer to whether you are affected or not affected by these changes and what the impact of that would be. I will be using cross segments or cross sections of that flowchart in the next few slides to demonstrate how the changes impact on certain aspects or certain types of entities, and what that means for you if you are one of those that are affected by one of those particular decision paths. So if there is a legislative requirement to prepare financial statements, and that legislative requirement also says that the financial statements must be prepared in accordance with Australian accounting standards or simply just accounting standards, then you are affected by these changes. And the most common example we can refer to is the Corporations Act, Section 296, which requires that a financial report for a financial year must comply with accounting standards. So that's probably your most common example that I could refer to, but there are others. So you could have state or territory legislation that imposes a requirement and uses those specific words that I've highlighted there. And that kind of scenario would also be potentially affected by the change. So here are some common types of entities that will be within the scope of the changes. Large proprietary companies, which will also include grandfathered companies. I'll talk to that in a bit. Unlisted public companies, AFSLs. Now, AFSLs is an important group of entities which are affected, and I've got a slide that specifically looks at the impact of the changes on AFSLs, and I'll talk to that in a bit. Couple of others. So small proprietary companies are generally exempted, but there are some types of small proprietary companies which will be captured. So if you think about the Australian landscape, there are about 2 million odd companies. A vast majority of them are going to be small proprietary companies. A vast majority of them, therefore, will not be affected by these changes. Those that will be affected, the most common ones I've highlighted here. So when we're looking at small proprietary companies, the ones that are likely to be captured will include small proprietary companies that are foreign controlled. And there are some exemptions there as well, and I'll talk to that in a bit. Small proprietary companies directed by ASIC, or the Australian Securities and Investments Commission, to prepare a financial report. Those kinds of entities would be captured. Then there are some small proprietary companies where 5% of shareholders require a financial report to be prepared under the Corporations Act, and I'll talk to that as well. There's a list of other types of entities which are mainly for-profit entities which would be captured under these changes, which I've listed there. So if you're one of these types of entities, then please be aware of these changes and start preparing. Now, here are examples of entities that will not be affected by the change. And this is, like I said earlier, this is going to be quite a significant number of entities in Australia that come under this category. So on average, if you've got, if you're either working for an organization which is a small proprietary company, or you're a practitioner with clients which are small proprietary companies, more likely than not, you're not affected by these changes. So rest in peace. You do have to think about the earlier slide that I showed you. If you come under this list, you do have to watch out for it. But if you come under this list, you're unlikely to be affected. So what are those that are not affected? As I said, a significant proportion of those 2 million odd small proprietary companies that do not have a statutory requirement under the Corporations Act to prepare a financial report will not be affected by these changes. Then there's the other group, which is public companies limited by guarantee. Companies limited by guarantee, a significant number of them are not-for-profits. And as I said earlier, not-for-profits are being considered as the second part of this project. So at this point in time, not-for-profits that are public companies limited by guarantee are not going to be affected by the change. There are some additional disclosures that are required for those that prepare special purpose financial statements, and I'll talk to that in a bit. Then, as I said earlier, you do need to watch out for the exact terms that are used in legislation. So, for example, if you've got a friendly society or retirement village where the requirement is to prepare financial information and not financial statements, then you will not be captured or caught by these changes. Other common types of entities that are not captured by the changes, SMSFs, that's a big group of entities that are not captured. So when you're preparing financial statements for SMSFs, there is no requirement to comply with accounting standards or Australian accounting standards in the legislation. So therefore, SMSFs are not captured by these changes. There are a few others listed there which may also be exempted by these from these changes because of the way in which the requirement is worded in the relevant legislation. So let's look at common types of entities that are not within the scope of the legislative requirements, but may be captured because of non-legislative requirements or practices. So I've so far talked about entities that are captured because of a legal requirement, like a statutory requirement, like the Corporations Act, which might tip you in. But there can be scenarios where you have other types of requirements arising, non-legislative requirements arising. So for example, you might have a constitution document, a trust deed, or an agreement of some sort, which says that you must prepare financial statements in accordance with Australian accounting standards. Now, you can see once again the cross-section of the flowchart that I referred to earlier that is highlighted here. So we've just picked up some parts of the flowchart to demonstrate how the relevant section of the flowchart impacts on particular types of entities and particular types of decisions. So where you do have a non-legislative requirement to prepare financial statements in accordance with Australian accounting standards. Now, there is a difference here between the legislative and the non-legislative requirement. And the difference is with legislative requirements, it's financial statements that are prepared in accordance with Australian accounting standards or accounting standards. Here, the reference is only to Australian accounting standards. So do be mindful of that difference. And if you do have a requirement to prepare financial statements in accordance with just Australian accounting standards, then you do need to think about what this means for you. It doesn't automatically tip you in. I do need to tell you right at the outset. It doesn't automatically tip you in into the change, but some situations or some scenarios you may be required to change over. Now, what are the situations where you will be captured? So if you have a document containing a reference to preparing financial statements in accordance with Australian accounting standards, which is created or amended on or after 1st of July 2021, and that reference remains. So you've still got a reference in that agreement or constitution document that says you've got to prepare financial statements in accordance with Australian accounting standards, then you will be required to prepare general purpose financial statements. You will no longer be able to prepare special purpose financial statements. So it's quite important that if you've got a client that has a requirement that comes out of a constitution or a partnership agreement, where there is that specific reference, prepare financial statements in accordance with Australian accounting standards. And there is a consideration being given to making a change to that agreement or document post 1st of July 2021. It might be better for you to think about removing that clause or asking your client if they would like to get that clause removed. Because if you do leave that clause in, and it doesn't matter whether you change that particular clause, it doesn't matter if that particular clause is changed. If you could change the document for any reason, if that clause remains, then the change to general purpose financial statements will have to be taken into account for you. So just be mindful of that. So some advice is being given that if you're creating a new document, a constitutional document or a new agreement, and you're giving consideration to the preparation of financial statements, be mindful of this. If you've got if you want financial statements to be prepared, which is fine. If you do want those financial statements to be prepared in accordance with Australian accounting standards, you cannot do special purpose financial statements. You must do general purpose financial statements. So be mindful of that big change. Now, what happens if no change is made after 1st of July 2021 and you keep the existing requirements as they are and no change is made? Well, essentially, in that situation, your position is grandfathered. What that basically means is you do not have to move across to general purpose financial reporting. So post 1st of July 2021, you haven't changed your constitutional document, your agreement, whatever it is that makes reference to the terms that I've just talked about. You are not caught by these changes. So what that basically means is you can continue as you've currently been, what you've been currently doing. So if you're preparing special purpose financial statements, you can continue to do so. But you do have to make additional disclosures. Now, the standard that will require you to make those additional disclosures is not yet in play. As I understand it, the AASB, they've got a board meeting next week, and they are planning to approve the standard. So I've called the AASB 2022-XX here, and I've actually given a link to the pre-approved standard. So this is the document that is going to be discussed at the board meeting next week. And this sets out the disclosures that you will need to make if you're a grandfathered entity, which will continue to prepare special purpose financial statements, but you will be required to make these additional disclosures. So I've listed the disclosures there, which will be required to be prepared. So why you're preparing a special purpose financial statements, what material accounting policies were applied in the preparation of those financial statements. Then there's a requirement to disclose something around recognition and measurement. I won't go through each one of those. You can read them for yourself, and the slides will be made available. So please do have a read through and see if you do come down this particular decision path, then you will need to think about these additional disclosures. So be mindful of this. So as I said earlier, impact on specific types of for-profit entities we will look at. And those that are currently doing tier one there are two types of general purpose financial statements. I should say that at the outset. There's tier one general purpose financial statements, which will basically be GPFS, which complies with all the requirements. So your recognition, measurement, presentation, and disclosure requirements. So all four of those. And you would also have to prepare consolidated financial statements if you're in a group, if your entity is the parent of a group. Then you do have the ability to prepare a tier two general purpose financial statement also, which is everything. So full recognition, full measurement, presentation, consolidation, etc., but with simplified disclosures. So the only exemption, if you wish, or the only reduction in work effort is to do with disclosures. And the standard that tells you the disclosures that you need to make, which are simplified, is in AASB 1060. And so you can either do tier one or tier two. Now, tier one or tier two general purpose financial statements. So how do you determine which one you're going to do? That will depend on a test called the public accountability test. Now, once again, I won't go through what the public accountability test is. It's in the accounting standards, so please do look at what that definition means. And if you're a tier one entity because you have public accountability, you will prepare tier one GPFS. Similarly, if you do not have public accountability because you do not meet that test, you will do tier two GPFS. What we understand is a vast majority of those entities which are affected by these changes will be doing tier two, or will be able to do tier two GPFS, which basically means full recognition, full measurement, full presentation, consolidation, etc., but simplified disclosures. Okay, so let's just look at some of the common types of entities that are captured, which I already told you about earlier. But as I said, large proprietary companies which are currently lodging special purpose financial statements will definitely be caught by these changes. And this will include grandfathered large proprietary companies as well, which are currently doing SPFS. They must move to GPFS. And as I said, they can do tier two GPFS if they don't have public accountability. And it's also probably worth mentioning at this point that the thresholds or the limits that you've got to look at for whether your company is a large proprietary company or not was changed after 1st of July 2019. And if you meet two of the three criteria on this slide, so consolidated revenue of 50 million or more, consolidated gross assets of 25 million or more, 100 or more employees. If you meet two of those three, you're a large proprietary company, you must do GPFS. You can do tier 2 GPFS, as I said earlier, but you must do GPFS going forward, including 30th of June 2022 and beyond. Other types of companies that will be captured, unlisted public companies. So these are not listed public companies, but unlisted public companies. There are a few thousand of those, as we understand, and they will automatically be required to do tier 2 general purpose financial statements, no longer able to do special purpose financial statements. I talked about small foreign controlled companies earlier. Generally, they will have to do GPFS, but there are a couple of exemptions. So if you're a small foreign controlled company that is not part of a large group, and if the directors have resolved to rely on the relief from preparing and lodging a financial report under the ASIC instrument 2017/204, then you will be exempted from the change. Similarly, those small foreign controlled companies whose parent has lodged consolidated financial statement with ASIC will also be exempt from the change. And the other types of companies that will be captured, companies requested or directed by ASIC to prepare a financial report, you will have to do GPFS generally, because if ASIC requires it, you would normally think that they will want general purpose financial statements to be prepared. I would think it's unlikely they'll allow a company in that situation to do special purpose financial statements. So be mindful that if ASIC gives a direction, it's likely that they will want GPFS. Then I've talked about companies requested by shareholders to prepare a financial report. So this comes under Section 293 of the Corporations Act. Now, there is a small sting in the tail, if you wish, or a small possibility that you don't have to do GPFS. So if 5% or more of shareholders direct a company to do a financial report under the Corporations Act, normally it would have to be GPFS. But shareholders can specify within that same direction that the financial report does not have to comply with some or all of the accounting standards, in which case SPFS is possible. But just be mindful, if shareholders, 5%, more than 5% of shareholders are asking for a financial report under the Corporations Act, they must have a reason for it. And it's quite possible that they will expect GPFS, but unless, of course, the shareholders specifically direct the company to do SPFS, or they exempt the company from applying certain accounting standards and preparing the financial statements, then you may be okay to do SPFS. But just be mindful of that direction for certain small proprietary companies where that requirement might come up. I mentioned AFSLs earlier, and this has been something we've been trying to work our way through with ASIC over the last few months, because ASIC expressed a view a few months back that they expected all AFSLs to move to GPFS, preparing GPFS. There are a few thousand AFSLs, we understand, so all AFSLs will now have to move to GPFS, is what we understand. They have issued a media release to that effect, and that was issued a few days ago. I've given you a link to the media release on that particular slide, so please do go and have a read of the media release to understand ASIC's formal direction here. So if you've got a client who's an AFSL, or if you are an AFSL yourself, you can no longer do SPFS. You must have to do GPFS. The requirement normally for an AFSL comes from Chapter 7 of the Corporations Act, and possibly also from Chapter 2M, which is the one that relates to the general requirement for all companies. Now, if you're an AFSL, which is also a company, you may be captured under both chapters, but the primary chapter to start off with is Chapter 7. of the Corporations Act. And if you are an AFSL, like I said earlier, you will have to do GPFS. Now the question then is whether do you need to do Tier 1 or Tier 2 GPFS? A number of AFSLs can apply that public accountability test that I talked about earlier. And you can determine whether, if you're not publicly accountable, then you can do Tier 2 GPFS. If you're publicly accountable, you must do Tier 1 GPFS. But ASIC has deemed some AFSLs to always prepare Tier 1 GPFS. I'm not going to give you the list. There's a sort of a few entities in that list, few types of AFSLs in that list. So please do read the ASIC media release, which includes that list. If you've got an AFSL that falls within that list, you must do Tier 1 GPFS. Otherwise, you can do Tier 2 GPFS, provided you are not publicly accountable. Now, the important thing to note, ASIC has provided a 1-year deferral of the new requirements to AFSLs that are currently preparing special purpose financial statements. But that 1-year deferral is only for those AFSLs that are caught by Chapter 7 to prepare financial statements, not Chapter 2M. So if you're only required as an AFSL to prepare financial statements under Chapter 7 of the Corporations Act, then you can delay your move to GPFS by 1 year. And that is also mentioned in the ASIC media release. So please do look out for that. The other thing that you probably want to be aware of is the form that sets out, the ASIC form that sets out all the details around the financial reporting requirements for AFSLs is Form FS70. The new form, FS70, which will set out all these requirements in detail, has not yet been published. We understand that the form will be published by the end of June. So do watch out for that. And we'll certainly put out a communication once the form is available. So you can have a look at the form and the details that ASIC has provided in that form for your move to general purpose financial reporting. Just be mindful, if you're an AFSL, no longer can do SPFS. You must do GPFS. Just be mindful of that. The other one I'll probably mention is QBCC, Queensland Building and Construction Commission. Now, this is a state-based requirement which only affects licensees who are regulated by the QBCC. And broadly, license categories 4 to 7 will be required to move to GPFS from SPFS. So if you're a category 4 to 7 licensee regulated by the QBCC, you will now need to do GPFS. However, QBCC has also provided a 1-year transitional provision. So that means that if you have no other requirement, so if you're a company, if you're a large proprietary company that is also a QBCC licensee, you're already captured under the Corporations Act to prepare GPFS. So that's already in play. So you can't make use of that 1-year deferral that the QBCC has provided. However, if you're a category 4 to 7 licensee who may not be caught by another requirement like being a large proprietary company, you can defer the change to GPFS by 1 year. So you would only be captured for 30th of June 2023 onwards. But we do have a flowchart on this, and the link to that flowchart is provided on this page. So please do go to the flowchart and work out what situation you're in. If you do have a client or you yourself are a QBCC licensee which will be affected by these changes. So please do have a look. Okay, if you're not a for-profit entity, so basically you're a not-for-profit entity. Now, I said earlier that the not-for-profits are currently being considered by the AASB, and they've got a project looking at the removal of special purpose financial reporting for not-for-profits. That is entirely true. The AASB is also issuing we believe the AASB will be issuing a consultation on their proposals for the removal of special purpose financial reporting for not-for-profits later this year. But if you're a not-for-profit that is either a charity or a company limited by guarantee, so this is a charity registered with the ACNC, the Australian Charities and Not-for-Profits Commission, or a company limited by guarantee under the Corporations Act, you are required to make some additional disclosures, and you would have already been doing that because the disclosures have been in play for the last 2 years. So the reference to the requirements are given in the flow chart, and now this cross section of the flow chart that deals with this is on this slide. So you do have additional disclosures, and that would be the case. The important thing is if you're a charity registered with the ACNC, there have been some changes to the thresholds to report to the ACNC. And if you're preparing special purpose financial statements and lodging them with the ACNC as a charity, you do have to comply with minimum mandated Australian accounting standards. Now, until last year, until 30th of June 2021, there were 5 mandated standards, which are listed on this page in white. There is a 6th standard that has been added this year for 30th of June 2022. Now, the important thing I'd probably say is for this year, 30th of June 2022, large charities will need to disclose key management personnel remuneration disclosures. So you've got to make remuneration disclosures for key management personnel, and there are some conditions around that. I won't go into the details of those disclosures. It's only large charities, and it's only from 30th of June 2022. You've got to make disclosures of key management personnel remuneration from this year. We are holding a webinar on not-for-profit changes later in July. I think it's on the 14th of July actually, but the details haven't been put up on the website, on our website yet. But do look out for that if you've got a client or you're part of a not-for-profit. That webinar, we will talk a little bit in detail about those changes. I won't go through that here now, because that's not the focus of this particular webinar. And then we have public sector entities. So if you're a public sector entity, you can continue to prepare, well, many public sector entities don't do special purpose financial statements anyway. A large proportion of them already do GPFS. If there are any that do SPFS, you can continue to do so. There are no concrete details at the moment on how and when and what the changes are, but when they do and happen, we will let you know. So at this point in time, if you're a public sector entity, you carry on doing what you're doing. But like I said, most public sector entities do GPFS anyway, so this shouldn't really be a big change for public sector entities. So determining the content of financial statements is important. So let's take the first step is, are you captured by the changes? If you've determined that you are captured by the changes, so you're no longer able to do SPFS, like I said earlier, you could do a tier 2 GPFS if you do not have public accountability. So this slide, we're just looking at some of the key things you have to look out for when you're moving to GPFS. So the key areas of revenue recognition and measurement that are going to probably be important. Now, these are not the only ones. There may be others. We've just highlighted a few here that you would probably need to be mindful of. AASB 15, revenue and income recognition. Quite a big change from the previous revenue standard, AASB 118. So we've now got AASB 15. So you do need to follow the revenue recognition requirements in AASB 15, so watch out for that. Leases is another big change, AASB 16. Most businesses will have a lease of some sort. If you've got a lease, you've got to follow AASB 16, which basically requires you to put most leases onto your balance sheet. So do be mindful of AASB 16. AASB 9 on financial instruments. Now, most businesses will have some sort of financial instrument. So you might have a debt You'll have trade receivables or trade payables. Those are all financial instruments. Even cash is a financial instrument, although the accounting for it is not complex. Do be mindful of AASB 9, AASB 132, and also AASB 7. But AASB 7 is on disclosures, which may not affect you. So be mindful of 9 and 132. AASB 112 on tax is important. So you may be required to do deferred tax calculations and other things and present them in your financial statement. So be mindful of that. 119, AASB 119, employee leave provisions, that's probably important. And 137 on provisions and contingent liabilities and contingent assets may also be relevant. So do be mindful of any employee leave provisions like long service leave provisions or annual leave provisions that may have to be made, if material, in your financial statements. And most importantly, consolidation and equity accounting. So if you're a group, so if you've got a parent with subsidiaries, you have to consolidate. That is very specifically set out in the changes. So you must prepare consolidated financial statements for a group. And if you've got associates or joint arrangements, you do need to apply the relevant accounting standard and prepare equity accounting for those types of entities as part of your consolidated financial statements. Now, the other thing to be mindful of, 30th of June 2022, year end, when you're doing your first Tier 2 GPFS, you have to include comparatives for the 30th of June 2021, and those comparatives must comply with all the same requirements. So they must be prepared and presented on the same basis of recognition and measurement as the current year. So you effectively have to rework your comparatives. If you've previously done SPFS for 30th of June 2021, you can't present that as comparatives. You must change your numbers and change your disclosures for GPFS for 30th of June 2022 and the comparative period for 30th of June 2021. Now, do be mindful, AASB 1060 does introduce several new disclosures. So please do carefully read through the standard and appreciate those disclosures that are required when you're moving from, if you're moving from SPFS to GPFS. Now, what about entities that can continue to prepare SPFS? Now, I suppose you could say, look, no change to what we're doing. We're going to continue to do what we've always done. But please be mindful that even when you're preparing SPFS, SAC 1, Statement of Accounting Concept 1, presumes that the report is being specifically tailored to meet the needs of a limited number of users. So that's the only reason why you're able to do SPFS. So the directors and owners of the business will have to determine the appropriateness of preparing SPFS by applying SAC 1. And you do have to consider the existence of users who may be reliant on the financial statements and whether that has a role to play in determining whether you should do SPFS or not. The other thing to be mindful of is that test is an annual test. So it's not like you do it once and you forget about it. You do need to make sure that you're continuing to be, you continue to not be a reporting entity to be able to prepare SPFS. Now, even though it's an annual test, most entities do not change significantly in terms of their business model. So it's quite likely that you're okay, but it's worthwhile just keeping an eye out and making sure there are no significant changes in your business model or your business itself. You haven't grown vastly in size or you haven't changed your ownership structure or anything like that. So be mindful of those kinds of things. And as long as those checks are done, you should be okay to continue to do SPFS subject to your assessment under SAC 1. I can't emphasize more than what's on this slide that you have to absolutely plan for the transition. It's not an easy task. It's a complex area. I know I've spent the last 45 minutes, 50 minutes talking about the changes very, very quickly. And it is, like I said, quite a complex technical area. So please do give allowance because there can be additional work. So the first step is the assessment. Are you affected or not? The second step is once you have determined that you're affected, what to do. So please do spend more time, give allowance for more time and resources as staff, etc., to prepare those financial statements if you are affected. Also be mindful of the auditors' fees and the effort that the auditors have to put in if your financial statements are audited. The effort that the auditors have to put in auditing not only the current year but the comparative year and the opening balances as well, because all that will change. So do be mindful of the specific circumstances and understand how these changes impact you on your current reporting. Please do allow for sufficient time, like I said, and the resources needed, and take advice from accountants and speak to your auditors as well. Make sure that you engage early with them so that you can plan ahead and make sure that you're addressing the changes correctly. Now, I've given some tools and resources here, which are all embedded with hyperlinks. So these are all resources that the AASB has made available. And that's the first lot that you've got there. There are 3 webinars that the AASB held. So please do go and have a watch of those webinars to understand the technical detail behind these changes. And there are other links there to the amending standards and some fact sheets that would be relevant to you as well. I've already mentioned that this whole webinar has been shaped on the guide that we've developed with CINZ and HLB Manjad on the removal of special purpose financial statements. So please do have a read through the guide, and we will be making available a link to the webinar, this particular webinar recording. It should be available at the same place where the guide is. And of course, those who are registered, I'm pretty sure you'll get a copy of the recording sent through to you so you can watch it in your own time and convenience. Now, I do want to mention a couple of additional upcoming webinars that are probably important and maybe useful to you. We have got an audit and assurance webinar, which is basically providing you with an update on the changes that you'd need to consider as an auditor. And a large proportion of that will also run through some of the things that I talked about today. So that will be a webinar I'll be presenting with my colleague Tiffany Tan, who's our audit and assurance policy lead, and the date and time is given on that slide. Click through the link and register if you're interested in attending that webinar. Like I said earlier, we're also doing a not-for-profit regulatory update in July. The details for that is not up and available yet, but it's to be held on the 14th of July. That's the tentative date that's been booked at the moment. So please do watch out for the webinar when it's announced on our website, and do register and listen to that webinar if you've got a interest in the not-for-profit sector. And that will cover not only the changes that I mentioned earlier to charities and other things, but also any regulatory changes which will be relevant, which is outside of financial reporting. So please do have a listen to that as well. Now, I am slightly ahead of time, but I did want, like I said at the beginning, I did want to spend more time talking about the changes, which are quite complex. I can't emphasize that. Like I said, please do look at the guide. Now, we do have ample time for questions, and we've got more than half an hour for questions. So let's see if there are any questions coming through. I'm just going to quickly see if there are any questions. Let's have a quick look. Helen, I'm trying to see the Q&A box. I can't see it on my screen.
Yeah, so to open the Q&A box, if you just click on the three dots at the bottom right, then you can open that panel up.
Okay. All right. Doesn't
Looking
look
at the
like
Q&A. Yeah, sorry. I'm
doesn't look
looking at the Q&A box, Ram. There's no questions in there.
I must have done a very good presentation. Like I said, I can't emphasize again, this is a complex area. So if you've got a specific set of circumstances, then let's have a look. One question has come through, so let's just open that up. So no trust deed created or amended after 1st of July 2017, 100% owned subsidiary is required to prepare GPFS. If the parent entity is unit trust and the 100% owned subsidiary is company, parent entity could still choose to prepare SPFS. Okay, so there's a few questions in that particular question. So the parent is a unit trust, subsidiary is a company. Now, if the subsidiary is captured by the changes under the Corporations Act, sorry, not the changes under the Corporations Act, but if it's captured under the requirements of the Corporations Act to prepare GPFS, so it could either be a large proprietary company itself, or it could be one of those types of companies that are captured by the change, then yes, it will do GPFS. So which is what I think the question says. Now, the parent is a unit trust. Now, as a unit trust, the question is, does the parent have an obligation to prepare financial statements itself? So if the parent itself has no statutory obligation, so normally under trust law, I don't believe there are any requirements specifically that sets out financial reporting requirements, particularly in compliance with Australian accounting standards. So if there are no legislative requirements applicable to the parent, and it doesn't have a constitution or other trust deed or something like that, which makes those specific statements that I talked about earlier, and it hasn't been changed post 1st July 2021, then the parent probably is exempt. Like I said, there are a few caveats I've put there. One is, are there any legislative or other requirements on the parent, which is a trust? Normally, as I said, legislation doesn't deal with trusts, it deals with companies and other things. Second thing is looking at the constitutional document like a trust deed. Is there anything in there? So if there's requirements, no requirements in any of those kinds of documents and other legislative reference points, then you might be exempt for the parent itself, because it itself doesn't have a requirement to prepare financial statements. Now, it does depend on specific circumstances, but I hope that clarifies that particular question.
Ram, we have received another question on chat. So it says, if two individuals who both have Australian financial service license and they are operated under a trust, do they need to prepare GPFS, or they can continue to do SPFS? They will be,
Yeah.
I can't ask the rest of the question. Yeah.
Thank you, Nadi. The answer is quite simple, and unfortunately, if you're an AFSL, regardless of whether you're formed under trust or not, you're caught under Chapter 7 of the Corporations Act and the ASIC requirements that sort of have been placed on top of the Chapter 7 requirements. So any AFSL will have to prepare GPFS. No SPFS for any AFSL. That's what ASIC has told us. Please do read that media release. So even if you are under a trust or any type of vehicle that you're formed under, you do need to prepare GPFS. So no exemptions, unfortunately, for that particular scenario. Sorry about that, but unfortunately, that's the way it is. That's what ASIC has decided. So there's one more question here. Yeah, look, I can't speak for what newsletters, technical updates, etc. say, I think it's important to bring awareness to this issue. And whilst it's quite correct for me to say that a vast majority of preparers of financial statements will not be affected by this change, those that are affected will be significantly affected. So even if those that are affected are a small proportion, a minority if you wish, the change is such that you have to be really, really mindful of the change. So that's why it's sort of emphasized time and again, this change is coming. If you're preparing financial statements that state compliance with accounting standards or Australian accounting standards, be mindful of this change. But like I said again, a vast majority of entities, like small proprietary companies, which is a big proportion, will not be affected.
We have received another question, Ram.
Yep.
It says, how many entities do you think will be caught due to, sorry, it's just disappearing?
Okay, let's have a look. Just pulling up that particular question. Just give me a second. Okay, how many entities do you think will be caught due to their constitution or deed requirements? Now, there is no register or record of deeds and constitutional documents as such. So, because these are usually held by the organizations themselves, so there's no public information available as such. I mean, there are, ATO probably has some information on that, but as far as I'm aware, there's no number that I can point to, unfortunately. There are numbers for companies and other types of entities which have legislative requirements, but because these are requirements set out in private documents, essentially, we have no visibility over the volume. So unfortunately, I'm not able to give you a proper answer to that particular question on volume, unfortunately. Apologies. One thing that probably worth mentioning whilst questions are being put through is what happens if you've got a corporate trustee parent with a trading trust. And what happens if in that scenario, the trading trust would essentially be large, let's say, for any other purpose, and the corporate trustee sits on top, so it's sort of a trustee on top. Would the corporate trustee, which is a company, because it's a corporate trustee, would it be captured by the change? It will depend, is the answer. It will depend on whether the corporate trustee controls the trading trust under the accounting standards definition of control. So if the corporate trustee does control the trading trust, you've got a group there, you've got a parent subsidiary relationship. And if that group meets that large proprietary company test, which I presented in one of the slides, the 2 out of 3 test, 50 million revenue, 25 million assets, 100 employees, then you will have to move to GPFS. But if the corporate trustee is not controlling the trading trust, now control itself has to be determined through a number of factors, and I'm not going to go through how you determine control. Look at AASB 10, which sets out the characteristics you need to consider when determining control. So look at AASB 10 to determine whether you've got control by the corporate trustee of the trading trust. And if that control doesn't exist, the corporate trustee itself is not a parent, and it may be small by itself. If it's small by itself, then it's not captured by the changes. So it's important to look at that control test when you've got a corporate trustee trading trust scenario, which is not uncommon.
Ram, we have another question regarding AFSLs. It says, does the ASIC media release outline which type of AFSLs had to prepare full Tier 1 GPFS and which could prepare Tier 2 Simplified Disclosure GPFS?
Yes, it does. So what the media release basically sets out is it gives you a list of entities that are deemed as tier 1 by ASIC. And so if you've got that, if you're one of those entities that are deemed by, let me see if I can pull up that media release to give you the, because we've got some time, I might as well tell you the types of AFSLs that are going to be deemed to require, to be required to prepare tier 1. So give me a second while I do that. Okay. Okay, here's the media release. So the entities that are deemed, AFSLs regulated by APRA, the Australian Prudential Regulatory Authority, participants in a licensed market, participants in a clearing and settlement facility, retail over-the-counter derivative issuers, wholesale electricity dealers, corporate advisors that deal in financial products, over-the-counter derivative traders, wholesale trustees, responsible entities of a registered scheme, corporate directors of a corporate collective investment vehicle, providers of a custodial or depository service, operators of an investor-directed portfolio service. Now, what we understand this list is relating to AFSLs that are likely to be quite large and are likely to meet that public accountability test anyway. So if you've got one of those entities that I've just read out, then you will have to do tier 1 GPFS. If you're not on that list, you still have to do one more test. Do you meet that public accountability test or not? And if you don't meet that public accountability test, you can do tier 2 GPFS. But if you do meet that public accountability test, you will have to do tier 1 GPFS. For example, if you're ANZ or NAB, you probably hold multiple AFSL licenses. And as the main body, you are going to be publicly accountable because you're going to automatically meet that definition because your shares are traded on the ASX. So it really depends on that particular definition and the test. But if you're in one of those, if you're one of those entities that I've just read out, then you're automatically going to be required to do tier 1 GPFS. Okay. Are there any other questions?
There's no further questions, Ram.
Okay. Look, I can't keep emphasizing the extent of the change. So AFSLs, you're caught QBCC categories 4 to 7, you're caught large proprietary companies, you're caught unlisted public companies, you're caught certain types of small proprietary companies, you're caught. So just be mindful if you're a small proprietary company or your client is a small proprietary company and is not one of those ones that are foreign owned or shareholders require financial statements to be prepared, etc., you're probably okay because you might be doing financial statements for tax purposes or making sure that the financial activities of the business, the owners have visibility and control over that. That's the main reason why financial statements are being prepared. Then it's unlikely that you're caught, and that applies to a vast majority of that 2 million odd companies that are under the Corporations Act in Australia. The extent of the change will only impact a few thousand entities. So we're talking about around 7,000 to 10,000 proprietary companies, a similar number for unlisted public companies, etc. So the numbers are not significant in terms of that broader volume of companies that I've just talked about. But equally, do check your situation and do make sure that you're not one of those that are captured by the change. Okay. Look, I know we are ahead of time by about 20 minutes, and I was sort of hoping more questions would come through, and I did want to give extra time for questions at the end, but it looks like questions have dried up, which can quite happily mean that you can have about 20 minutes of your day back to do other things, probably go have some lunch or something. So I'll stop there and I'll thank you very much for today's session. And I'll pass back to Helen.
Thank you, Ram, for your session today. And also thank you everyone for being online. In the next 3 working days, you will receive an evaluation survey accompanied by the recording of this webinar. We really appreciate your feedback as it is extremely valuable to CP Australia to help us to deliver better events for you. Thanks again, and we look forward to welcoming you to another CP Australia webinar soon. Bye for now.